Hey everybody, welcome to the Middle Class Investor. It is Saturday, June 3rd, and doing the recording tonight in the evening, about 11 o'clock on Saturday. So what we're looking at here, let's back up. Let's go to a 10-year chart. There's the March 9th low. We got this run up. It's been lasting forever. In fact, this has been said, this has been the most hated bull market in history. I don't know if that's true or not, but certainly I am not liking it because it's not cooperating. So you can see here that this channel, this channel's not it's not well drawn actually. And I don't even know if I can get it to cooperate. Yeah, I can get it to cooperate. It's better drawn now. So let's click there. Okay, so I got the wave 1 high and the wave 3 high connected, and then I've got the bottom part here connected. So you can see here that zoom in. You can see we had an up week. Let's see what we went to. This is about right there at 24.39. Pretty big week actually. I mean, we were trying for the longest time. We were holding on to this 2400 right through here, and finally broke out of that, and last week, and then continued up through it this week. Now, if we get another week up, if we get another one of these, we might have to abandon the whole ABC, because this could still be B, but once it gets a certain amount high, you can see if I had a decision point, I'd put it about right here, and we're still technically kind of in it. But if we peak up above it next week, we're going to have to abandon this and maybe rethink where we are in this trend, which is not the end of the world. It's just the pattern is playing out differently than we thought it would, or that we anticipated it would. But for now, let's go ahead and talk about the likelihood of this starting to roll over and come down kind of near this low. So we're not going to expect it to make substantially lower lows than that. It may not even make a lower low. It may just come down roughly to the same point and then start rallying up. But this could take, if it does do that, we're talking about 3 or 4 weeks to the downside. So I would say if we might start off the week, up and then fail. But if we start off the week up and we keep going up, then next week you'll be hearing me talking about no more of that. There's something else at play here. There's what's called intermarket divergence going on. The Dow and the S&P are not they're not tracing out the same kind of patterns. So let's look at the Dow real quick. So you can see the Dow is just barely above the prior high. If I go back to the S&P 500, it's significantly, here's the prior high right here. It's significantly higher than the prior high. So we got this kind of intermarket divergence, which is actually bizarre, really, given that tells me, when the Dow is lagging something like the S&P 500, that tells me there's still a lot of bullishness in the market. So we could very well be talking about, instead of a correction next week, we could be talking about trying to identify the end of this last run up. Let's look at volatility. Volatility continues to be low, lower than ever, really, which is interesting. It just speaks of the complacency in this market and the likelihood of so many people just getting whacked. You can see we're almost at new lows here on the VIX, so that's potentially concerning if you're long the market. The 10-year yield, just like we talked about last week, and the pattern's clear, right? On the 10-year yield, so it's a little easier to kind of estimate what's likely to happen. And I still say this gap is likely to close. Hasn't quite closed yet, and I would say next week we're probably going to be looking at some sort of pullback that closes that gap, and then we could look for some sort of move above the low, or we could look for another move down the following week, and then potentially another move down again into this midpoint of this large white candle. And then we'll be looking for something maybe like this, where you have the high, the open and the close is inside the body of the previous candle. And then what we want to look for is something like this, where you get a close above this high right here, this candle high. And then we can start looking for the next wave up in yields. Now we've talked about on this program the TBT. The TBT was down this week because the TNX, or the 10-year yield, was down. Hopefully I haven't lost my internet connection. It's taking a long time. All right, well, let's come back to that. Oh, there it is. Okay, so we got a performance problem here. So you can see here the TBT pulled back in line with the TNX, which is the 10-year yield. The TBT is actually the 20-year bond. So it's slightly different. It looks like it's pulled back a little deeper, but it's the best ETF, high volume. You can see 7 million shares a day. That's quite a bit of volume. That's a good instrument for trading yield, and it doesn't degrade much. All these ETFs have some sort of expenses built into them, and in general, things like the TBT, the SPY, DIA, these have very, very low expenditures and very, very, very high trading volumes, which is what you want. You want to be in. There's some ETFs that are a little bit more outliers. They use a lot more futures contract trading and other derivatives in order to basically promise the performance that they get, and the expenses in them are quite a bit higher, and holding them for long periods of time could actually cost you performance in the stock, even though the stock is not moving against you. So you have to be careful with those. All right, let's look at the really short-term Treasury again. A lot of talk about the Fed and what's the Fed going to do. Hopefully by now that you guys understand that I've kind of beat it enough here, but the Fed follows rates, does not set rates. So clearly this chart is showing that the Fed will be raising rates, not cutting rates. I think could be potentially setting the market up for a little bit of a disappointment because the job report wasn't very good the other day, and of course the market went up, which, just goes to show you that even if you knew the news, I've heard people say that before, these, these people, some people get the news quicker than other people, and there's a lot about Twitter, people using these Twitter algorithms to get the news ahead of everybody else and all this kind of stuff. If you thought that the jobs number was bad, wouldn't you trade the market down? I mean, that seems logical, and yet that's not what happened. So what's interesting here is not only is this going up, but you can see the angle here, the increase in angle. It's actually getting steeper, which kind of coincides with kind of an anticipation that these short-term rates are going to be going up a lot faster than people think. I've been saying that for a while now. Timing was a little bit off. If we go back and look at the 10-year one more time, initially, let me back up a little bit further. Excuse me. Initially, I thought this was the low, and so I was thinking this was the first move off the low, and this was the first pullback. But as soon as we got a new low right here in yellow, let's zoom in on that a little bit. So you can see here. I'll stop that cursor right there where you can see this line here. You can see this low is in fact lower than this low. So that negates the fact that this is the low and this is the first move off the low. So you had to go back and kind of reset. And now this is the first move off the low. And we've had kind of you can kind of see it here in A, B, see the little lower high here, and then C down. And we'll probably get a little bit of lower low next week. And of course, if this is the first move off the bottom and this is the first retracement, then the next move should take us somewhere up in this region off the page, well north of 0.4%, probably closer to 0.5% I'm sorry, 5%. So 5% is up here where this box is, and if we let's see if we can get all this in the screen here. So if this is the first move off the bottom, so we got it kind of a 1, let's say 2 pulls back to there, and then 3 could literally be 5.5%. So be very, very careful in these bond funds. I've said this many times. I feel like the boy who cried wolf because it really hasn't punished many of you too badly yet. But those times are a-changing, so be careful. All right, let's look at the United Kingdom. Let's go back to a 5-year chart, since that's where we normally look. And so again, if this is an important top and this is some sort of move, this looks fairly corrective to me. It's inside this channel. It could break out and go to this new high up here, but at this point, I would say until it gets above 36, what I'm looking for is for this to be a rollover and go lower from here. Now what's interesting, let's zoom in here and take a look at some stuff. Well, let's not zoom in. What's interesting is you can see here the volume is kind of falling as it was making new highs. It'd probably be interesting to look at, let's do studies. Let's just see if there's a little bit of divergence going on here. Edit study. Let's take the volume off. Actually, to do that, we don't need to do that, but let's put on a MACD, which is a momentum indicator. Let's use that one. Hit OK. And then over here, I'm gonna go to quick toggles and turn the volume off. Hide volume. Okay. For watch list back up there. Okay, so no, there's no divergence. Sometimes what'll happen is as the market's making a new high like this, the momentum indicator, in this case, this MACD oscillator. Let's see here. So there was a high here. Yeah, see, these are higher highs. There's almost one here, but this is not a higher high is the problem. So really what should happen is, let's say you had a high right here. Let's say this was a high, kind of going back in time. And let's say this histogram was kind of tall right here, like so. And then it pulled back. And then as it made this high right here, the market started to curl up and make a lower low. So see this, when this is going down, but this is going up, that's called a divergence. But we don't have that here. So I was thinking there might be one there, but it doesn't appear to be the case. So forget that. Let's delete that. Okay. All right. So again, you can see the UK going up, but until it breaks out above this 36, I would be cautious here, because this does look very corrective. It could be that this is kind of a 1, 2, and then 1, 2, 3, but really until it breaks out of this channel, you can't say that this is 3. I don't think. The NASDAQ has been really strong. Let's look at the NASDAQ real quick before we look at the other countries. The NASDAQ is up real strong, but you can kind of see here we had a move up, correction back, move up, correction back, move up. So likely we're getting very close to the end of this run here. And when we pull back, it's going to be a pretty hard pullback and probably all the way down to this box here close to 4,000. So if you're in the NASDAQ, just be careful, set some stops down below here somewhere, and don't get greedy and get in trouble trying to make more and more money out of the NASDAQ like it's the .com bubble or whatever. You can see that Japan is pulled solidly up into our resistance area. It looks pretty strong, so it could follow through next week with some higher highs there. Germany is chugging away here, doing the same thing, moving up to its resistance area. And that's about all we really look at in this part of the charting software. Let's come over here and look at let's look at crude oil. We haven't looked at crude oil in a long time. Crude oil had kind of a rough week, so you can kind of see these were, this little cluster of pricing action was pretty important. Which, if you go to the most recent pivot high, you can kind of see that from this pivot right here, that a logical place for the market to stop would be, in a decision point off of this pivot. And this sideways action just kind of ground the trend to a halt. And then you had this pretty solid move down, an almost 100% trace up, and then another solid move down. So let's look at this most recent move down. And so what you could have going on here is you could have kind of a 1, 2, and then 3. This all being 3 down, or it could be kind of an ABC. That if you look at crude oil, let's see, we're on a daily. Let's look at a weekly. Let's look at a 20-year weekly. It could be that this impulse move is over for now anyway, and then we've got some sort of wave 4 thing happening here where this could be consolidating for literally years. You got a high, and then you come back to a higher low than this low, and then you're back up but then to a higher low, so on and so forth. So if this is your move down, this would be A, this would be C, D, E. Is that right? Did I say that right? Let's see. A, B, C, D. No, E would be up. And then you might have a final move down into a low below this low here. So that's a potential for what we see here. It's just that we've got some sort of sideways pattern. Now, the good news about triangles, so this is really kind of a triangle, which is a type of sideways pattern. The good news about triangles is they happen at the end of a trend. So once we get into this area, this would be a great place to be long crude oil if this all plays out. And you can see here, this could take 3 more years to play out. So crude oil is going to be something, I mean, you can maybe do it for a trade, but that's, whoops, I don't know what's going on here. I can't get my, there we go. But even, so what I was going to say is you could trade inside the triangle, but you want to keep your stops fairly tight. Draw your patterns and make sure that you're not taking too many losses if something starts going against you. All right, let's look at gold and silver. Gold and silver basically are doing the same thing. We're looking right now for gold in this case to, you know, kind of meander its way up, you know, to this box, this decision point, which is off of this pivot right here. And what I would expect next is some sort of move here, some sort of full pullback like this, and then a really good wave 3 plunge. All the way down into here, which could take another 2 or 3 years. So, you know, this oil market is a big market, but it doesn't. There's certain days it moves fast, but most of the time it just chops around. Let me. Where is my? Okay, that's not what I'm trying to do. Sorry about that. Well, anyway, I guess I can look at it here. Let's see, 20 year. So let's just talk a little bit about crude oil here, if I can. Well, can't seem to get the chart I want. I know that's not 20 years there, so I'm not sure why. Not sure why that's not opening up, but long story short, you know, gold had a run up from 2001 to 2011, so 10 years. Then we've got this pullback happening, and then probably we're going to run up for 10 to 15 years again. So this is one of the reasons we're watching gold very closely. Is it, again, if this is a wave 1, we get a wave 2 pullback into here, then wave 3 is going to be very, very long. It's going to last a long time, and it probably is foretelling something negative about the US dollar, and maybe not just the US dollar, but worldwide currencies everywhere. So silver is very similar. We've got an expected run in silver up into this area. It could take quite a while, maybe even slightly higher. It could take quite a while, and therefore, you know, we probably shouldn't speculate on this other than to say that the target is somewhere between here and up here. And then the next target will be down here. So it's very, very common wave action. You can I didn't chart all this stuff myself. I mean, all the little 1s and 2s and 3s, but this is very easy to see once you see it all the time and recognize it. All right, let's look at we already looked at oil. We looked at Well, we haven't looked at the euro. So again, the euro starting to break out of this downtrend line. If it continues on this path, the target is up here. Let me see if I can get. Nah, that's not what I'm looking for. Well, I was just going to draw. Let me see here if I can just draw a box off of this decision point area here. So I would say a logical place for the euro to stop is in this 1.678 area, something like that. So, all right, we've talked about some potentially good areas to be in. Here's the U.S. dollar, British pound, U.S. dollar. Again, the reason I think these are such good investments is, and I know I've talked about this before, but you basically, these are such long-term moves, and the dollar, you know, the control of the dollar is in the U.S. Treasury. It's in the Federal Reserve, and the history of the world says that governments never do the right thing. So what does that mean? That means when faced with the choice between preserving the value of the dollar and, you know, suffering deflation and therefore, you know, being kicked out of office, governments, you know, usually do the wrong thing. In this case, the wrong thing would be to print money, expand credit, do things that reduce the value of the dollar, therefore valuing, in this case, the British pound, but also the euro and stuff like that. So that's why gold and silver and some of these other commodities and currencies outside the U.S. are so important to look at. I guess that's it. That's all to say about that. Let's see, where do we want to go now? I think maybe that's probably about it. I was going to show you. Oh, that's the wrong. I wanted to show you, you know, kind of what it looks like on the Elliott wave when they chart. So this is the. Let's zoom in on this so you can see it a little bit better. This is the most recent run up from, it was February low back in here, and this is what's called, this is what Elliott wave is calling intermediate wave 5. So each one of these moves is a minor move. So this is minor 1, this is minor 2, this is all minor 3, and then we're in the midst of minor 4, which again should look something like that. And then of course after 4 you have a 5. So once this is all complete, what Elliott wave is saying, and I'll show you here in a minute, but I just want to highlight or read to you here what it says. It says, I'm not going to bore you with the wave 5 and all this other stuff, but it says 5 minor degree waves will compose it, and 3 of them are complete. So this is what I was talking about. So what's complete? Well, wave 1 is complete, which is right here. Boom, like this. This is wave 2. And then this is all wave 3. So really, again, once 4 is complete, and it shouldn't go substantially below this level here. And then we're looking for the next move up, which is, you know, it may just be a slight higher high. And then, according to these guys, all hell's going to break loose. So let me read this. Let me zoom in read this real quick. So it says 5 minor degree waves will compose it, and 3 of them are complete, as the chart at the right shows. While the stock market's long-term top still lies ahead, the advance is in a mature stage. Minor wave 4 is progressing now. When it is finished, it will lead to minor wave 5, which will conclude the entire bull market of the last, or of at least the past 85 years. So what does that mean? What are they talking about there? Well, I've talked about this before, but the market tends to unravel in a fractal. So this is a good example. So this is a minor degree wave 1, it's a minor degree wave 2, but then this is a minute wave 1. So in other words, 3, so 1, 2, 3 is made up of a minute wave 1, a minor wave 2, a minute wave 3, a minute wave 4, and a minute wave 5, concluding 3. And then we start the count we're trying to have here. And so there's a lot going on here, and there's still some, as you can see, there's still an alternate. But I think it's important to get the big picture, because there's going to be a lot of stress in the market, and you need to kind of know what to do before that stress comes upon you. All right. I guess that's it for this week. I'm just looking here to see if there's anything I missed. I mean, we didn't look at the the YM or the GC index or some of these other futures, but well, I'll tell you what. Let's look at the British pound US. Oh, I'm already on that. I'm already on the British pound US dollar. So we're on a weekly chart. We've got this pretty substantial move. It looks like a 1, 2, 1, 2, 3, right? 4, 5. And it could be. So we'll just have to watch. We'll have to watch these closely. I think I told you that if you want to bet on the British pound, you can look at the FXB British pound, and you can see it still hasn't pulled back to the area I would like it to pull back to, which is somewhere along this red line here, and then we're going to have a big check mark. All right. I guess that is it, everybody. I've spoken for a long time. It's probably time for me to get off and let you get back to what you're doing. Just be patient, be cautious, and above all, don't lose money. That's the key to the game. So, all right, I hope everybody enjoyed that. If you have any questions or comments, just leave them in the video comment section, or you can write me at InvestorClass on Twitter. Again, that's at InvestorClass on Twitter. All right, everybody, thanks for coming in this week. Appreciate it. Look forward to seeing you and talking to you next week. Take care. Bye-bye.